Babcock International closed up 7.6% on Tuesday, the single biggest one-day gain among Britain's listed defense contractors. BAE Systems added 1.8%. QinetiQ rose 3.8%. Rolls-Royce gained roughly 2%. All four moved on the identical piece of news, yet Babcock's reaction was nearly double the next largest gainer. The trigger was Andy Burnham naming John Healey as Chancellor of the Exchequer, just weeks after Healey resigned as Defense Secretary over a funding dispute. Every defense stock read that appointment the same way. So the open question is not whether the news mattered, it clearly did, but why one company's shareholders reacted so much harder than the others to the same fact. Healey's resignation letter accused the previous government of being unwilling to commit the resources the country needed against rising threats. He argued Britain needed defense spending at 3% of GDP by 2030, well ahead of the roughly 2.68% path the outgoing plan implied. The market's provisional answer is that the man who quit over inadequate defense funding now holds the purse strings that decided, and Babcock's UK order book stood to gain the most from that switch.
The revenue mix explains the gap. Over 70% of Babcock's revenue last year came from the UK. BAE, by contrast, drew just 28% from Britain and nearly half from the United States, where its own defense budget dynamics dominate. A pound of incremental UK defense spending lands almost entirely inside Babcock's order book. For BAE, it is diluted across a global portfolio. But that same UK concentration is also why Babcock has historically traded cheaper. Its forward price-to-earnings ratio sits near 16, against roughly 21 for BAE, and its dividend yield of about 1.2% lags BAE's 2.2%. The market has long priced Babcock as the higher beta, lower quality play on UK defense policy, specifically because its fortunes swing harder on exactly the kind of political signal that just fired. That reframes Tuesday's move. Babcock did not simply react more to good news, its structure is engineered to react more to any signal about UK fiscal intent, favorable or not. The 7.6% gain is not proof the thesis is right. It is proof the stock is the most sensitive instrument for testing whether the thesis holds at all.
If Healey's appointment genuinely signals a durable increase in defense borrowing, the bond market is the place that would show it first, because gilts are what actually fund any spending increase. On the day of the appointment, the 10-year gilt yield was about 1 basis point lower and still sat above 5%, essentially unmoved. Sterling firmed only modestly. IG's chief market analyst, Chris Beecham, was explicit about the limits of the read. He said Healey will have many competing demands as Chancellor and will not simply act as the Ministry of Defence's advocate at the Treasury. Berenberg's senior UK economist offered a narrower version of the same caution, noting Healey's resignation suggests he will push to raise military spending, but how any increase gets financed remains unresolved. That is the paradox sitting underneath Tuesday's rally. Equity investors priced Babcock as if a fiscal decision had already been made. The gilt market, which would have to absorb any actual increase in borrowing, priced the same appointment as if nothing had changed yet. Both cannot be reading the same fact correctly, and only one of them is pricing the eventual budget outcome rather than the headline. The variable that resolves this sits ahead, at Burnham and Healey's first budget this autumn, when any defense commitment must appear as an actual costed line rather than a personnel signal. If that budget moves gilt yields meaningfully in response to new defense borrowing, Tuesday's rally becomes the correctly early entry into a genuine re-rating. If the budget arrives with the same fiscal restraint Healey has already promised and gilts stay flat, Babcock's 7.6% becomes the case study in mistaking a cabinet reshuffle for a funding decision. Holders should treat the current gain as provisional until that budget prints. Watchers should treat the entry price as unconfirmed until the gilt market, not the equity market, moves.